What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we are going to be taking a look at shares of Tesla, if this is presenting a good long-term buying opportunity for investors, or if shares are overvalued and looking to deploy capital into other non-overvalued names. As always, this video is not investment or financial advice and is solely for entertainment purposes. All values that you'll see within this video are as of market close on April 24th, 2026. Let's dive right in here to the past 12-month price chart for Tesla shares. You can see that within that time frame, Tesla shares have produced a 50.3% return relative to the benchmark, which produced a 32.1% return in the same time frame. That does indicate a relative outperformance of Tesla shares to the benchmark of 18.2%. Now, when we look at that price chart graph in the top end of the snippet here, you can see that shares are trading still below their 52-week high by 23%. Shares are also trading below both their 50 and 200-day moving averages, and the 50-day moving average, that's that line in the green, has now crossed over the 200-day moving average. On the downside, a deadly cross, we call it, which does indicate a sell signal. Now, a few key points here. I'll touch on the target price of the 43 analysts on the next slide, but that EPS chart that you see at the bottom of the screen, bottom left, you see that EPS growth is not going to be as accelerated as years past. That is because of the heavy CapEx that Tesla is doing. They are undergoing a fundamental restructuring of their business, becoming an AI company, a software company, a robotics company, an engineering company, an energy output and producing company as well. And due to these high capex in certain areas, you are seeing those earnings and margins compress. And you can see that in the gross margin, which is 19.1%, yet the net margin compresses all the way down to 3.9% because of that heavy short-term investment of Tesla in its own underlying business expansion. And sales of 2.3% we'll touch on in a later part of this video. But that price to earnings ratio, when you look at it on the past 12 months, that screams an overvaluation of 344.1, and the forward PE of 179.6 is worrisome and is stretched by every means, I have to be honest. And the price of sales, but price to book as well, are not too overly concerning as well, and are actually lower than some other Mag 7 names. And this I wanted to touch on here with the 43 analysts that have a target price of $405.59, which does imply a 7.59% return from where shares traded on April 24th, 2026. The biggest bull has a $600 price target, implying an almost 60% return, where the biggest bear has a below $25 price target and an almost 95% loss. You can see the wide discrepancy in analyst target prices. And as Tesla just reported earlier on in this week, we are seeing a lot more analysts have to change their target prices. Whether they revise it up or down, time will tell. But when we look at that chart there, I want to just point your attention to that blue line, which is the Tesla shares over the past 12 months, and the dotted line, which is the analyst target prices over the past 12 months. And you can look at this stat on any time frame or any time interval, and you will always see that when Tesla shares trade below the analyst target price, it does indicate a buy on Tesla shares. You can see that on the left side of the graph, which was the April 2025 mark, does indicate a good buying opportunity, and you can see that shares start to trade above the analyst target prices, and that is just because of the retail investor interest. Those analyst target prices do act as a kind of floor to Tesla shares. And it's quite funny when you look at how Tesla is compared in the space. It is a technology name and it's transitioning to a more technology-based name. Some say it's a technology company that just sells cars for fun. But when we look at it at a comparison basis, we compare it to other EV manufacturers. Now, Turbo Energy, Lucid, Finergy are laughable in a sense. They don't even have earnings to report. But you can just do that hilarious comparison let's just take the trailing PE of Tesla, 344.3, compare that to Volkswagen at 6.5. You can really see that wide discrepancy. But what I want to point your attention to is the margins that Tesla is able to work on. And you can see there that net margins of 4%, comparing that to Volkswagen that has been doing this for over a century now, and they have net margins that are half of Tesla's. But what's more important is the return on equity and return on assets that Tesla has compared to the group. Mind you, Tesla, like I said, is restructuring its underlying business and making more investments in technology, which does have a greater return on investment than, say, production output, which Volkswagen may be investing more in, which will generate a lower return comparative to the AI spending, data center spending, and technology research and development in its robotics divisions. Now, here you could see the trends downwards over the past 3 years of gross margins, operating margins, pre-tax margins, and net margins. And that is because, and I'll touch on this on the bottom for profitability ratios there as well on the return on investments, but those margins are starting to be compressed because of the heavy capex spending, and that has started in 2024. And those 10-year trend graphs that you see there, the last three bars are 24, 25, and starting to be 26. So you are starting to see that with that heavy investment, you are starting to see margins compress, and the return on assets, equity, total return on capital, and invested capital is shrinking in that time frame as well. And that is a short-term problem. Anytime you have a heavy capital deployment in the short run, you're not going to have an immediate return on that investment. But what I want to actually point your attention to is the operational efficiency. You can see the revenue per employee has grown over the past 5 years, and that is actually an amazing feature for Tesla on its sales side for its autonomous robotics in Optimus. Now, Tesla and Amazon are the biggest beneficiaries and benefactors of automation, and they're deploying it across their underlying businesses. But when they're selling, Tesla in this case actually is able to go to potential sales customers and say, hey, look, we're deploying our autonomous systems within our own gigafactories and factories, and it's actually produced a better output without us having to reduce our headcount, which in our bottom lines are showing that we're operationally more efficient, and the proof is in the pudding. So it's also a good selling feature for the robotics division of Tesla to have that operational efficiency in the revenue per employee growing over the past 5 years, and that is due to the heavy automation in Tesla's underlying business. After all the controversies over the past 18 months with Elon Musk, you can still see on a 5-year, 10-year compounded annual growth rates of 24.6 and 37.1 respectively of sales and revenue. You can see that margins are still looking great in gross incomes. Look at that 10-year compounded annual growth rate for gross income of 33.9% and pre-tax income also increasing over that time frame. Net income of 40.6% on a 5-year compounded annual growth rate. You see that earnings per share growth on the 5-year CAGR rate of 40.1%, which is phenomenal. And I just want to point your attention to the revenue breakdown geographically for Tesla. And you can see that the US still makes up slightly more than half of Tesla's revenue, but it wasn't the biggest growth area geographically for Tesla. In fact, that came from mainland China, which had a 3.1% year-over-year growth. And you see that trend going down. Initially, there were some issues and geopolitical issues and issues with the CCP and Tesla, which seemed to be, not going to say resolved, but subsided, let's say now. But if we can continue to have that 3-year trend upward and gain more market share in mainland China, that would be phenomenal. Europe and Asia has had that boycott of Tesla, which has decreased its revenue, but hopefully that can resolve itself in the future. Now, like I mentioned, Tesla has reported earlier on this week, and based on their last report, they did show a beat on both the top and bottom lines, despite some underlying pressures on margins like we saw. Let's just give you a quick snippet. Revenue was up 16% year over year to $22.39 billion. That was a slight beat to analyst estimates, which were 22.28 billion. We saw earnings per share grow 41 cents, surpassing the forecasted 36 to 37 cents per share, and net income of 477 million relative to the same quarter last year, Q1 of 2025, which was $409 million of net income, which this was a stunning stat, I will have to say. The total cash and short-term investments for Tesla reached $44.74 billion. What an amazing cash pile. And operating cash flow was 3.94 billion, which comfortably covered capital expenditures, which were 2.49 billion dollars. Now, while the financial numbers were strong, the volume data showed some signs of slowing demand, and we can see that here in the deliveries, which were 358,000, give or take, falling short of some internal production targets. And speaking of production, approximately 408,000 vehicles were produced, indicating a buildup in inventories. And Tesla's energy storage deployed 8.8 gigawatts of energy storage through the energy segment of Tesla, and that segment actually saw a 12% decline in revenue to $2.41 billion. Now, like I've been mentioning earlier on, Tesla is undergoing a significant shift. Tesla has recently agreed to acquire an AI hardware company for up to $2 billion in stock, and the SpaceX investment was disclosed at $2 billion of equity as well. You'll see a lot more interconnectivity of the Musk companies in the future, and especially with the space exploration. If you look at NASA's plans, SpaceX's plans, and even Blue Origin's plans, the integration of Musk's companies, that is SpaceX, XAI, and Tesla predominantly, you will need to see an integration of those for that space exploration that is projected. And an emphasis was placed on the cybercab and the full self-driving supervised, I have to say, capabilities that should drive future high margin recurring revenue, even if they're able to do the licensing, which I will touch on in a later point. But I just want to mention, with this AI investments that they're making, they are also spending heavily in terms of their capex, which is estimated to be around $20 billion annually as per their last report. That is essentially being funneled into proprietary AI chips and data centers. This infrastructure is seen as a moat relative to the legacy automakers, as they cannot easily replicate this model, nor on this excessive capex that Tesla has. Optimus, which is the humanoid robot of Tesla, has been described by Elon Musk as the quote unquote biggest product ever. Investors do see this as a way to address a massive labor market and labor market shortages depending on the region, which can shift Tesla's valuation towards industrial automation. And you can see that as well in underlying Tesla itself, how it has implemented that industrial automation, which has produced more output per employee, which what we want to see. And like I mentioned, with the full self-driving capabilities, 2026 is a big year. There should be the transition to the supervised to unsupervised full self-driving of the Tesla products and software. And there is ongoing speculation regarding Tesla licensing of this full self-driving technology and software to other automakers. And if this is the case, this would provide a massive revenue stream and essentially pure profit revenue for Tesla. Say they license this out to Ford, for example, which uses this Tesla full self-driving hardware and software in the future, then this is going to be traded essentially like a software segment of Tesla. And if we look at other SaaS segments of companies, those have high 80+% margins. And if they're able to capitalize on that, you can see that margin expansion hopefully in the coming quarters, as margins right now are being compressed through also not just the heavy capex, but also rising costs globally in the inputs for Tesla products. Even though we saw a decline in the energy storage segment, essentially Tesla is positioned to benefit from the global backlog of energy storage, and this Middle East crisis is not assisting. Also, with the massive and rapid data center buildouts, there is an energy demand, and as power grids modernize to handle more renewables coming to market, Tesla's software, like AutoBidder, for example, and hardware integration can make it a leader in distributed energy, infrastructure, and services. And I just want to mention here the financial discipline of Tesla. We saw that almost $45 billion in cash and short term investments, treasury bills, for example, where they're making little money but have the liquidity in case they need to execute and use that cash. And that $45 billion of a cash treasure chest does allow Tesla and give it the dry powder it needs to implement that research and development and that capex spending in its AI business and the research and development in the robotaxi, in the full self driving, and in the robotics division as well. And if they're able to have this dry powder, they don't need to go and tap the debt markets, especially now with rates as high as they are and projected to increase if inflationary pressures persist. Then they're not going to have to go issue debt, nor will they have to actually issue equity to dilute shareholders, which is amazing. Even though the company is going through a strategic pivot, the company continues to generate positive free cash flow of 1.44 billion, like we saw previously in the video. And this is proving that Tesla can fund its own, like Elon Musk described, moonshot projects that, again, doesn't need to be having any loans, debt issued, or equity issued on Tesla's balance sheet. Now, guys, again, this is not investment or financial advice. It's solely for entertainment purposes. Take this information as you will. And let's see if the long term is either beneficial or detrimental to shareholders. Thanks so much for making it to the end of the video, guys. Please do hit that like and subscribe button and stay tuned for the next video.